Welcome to Credit Versio's Q&A Wednesday live for January 5th. I'm your host, David Michalek, and we took the last 2 weeks of December off, but we are back. And now every Wednesday, we're going to go live at 6 p.m. Eastern Time on Facebook and YouTube. Happy you could join me today. Welcome, and please take a second to introduce yourself. I see that we've already got a handful of people on. Really appreciate you joining me. And for about the last 10 years, I've been a consumer credit expert. And during that time, I've done a little over 10,000 one-on-one credit coaching sessions with the goal of helping people understand how credit works, how important it is, and certainly how to improve it. And joining me today is America's #1 credit expert. He's back with us. He comes onto the lives twice a month. He's got 30 years of experience in the credit industry, including years working with both FICO and Equifax. Let's bring in John Ulzheimer. John, welcome.
Hello, David. Happy New Year to you, and Happy New Year to everyone watching.
Happy New Year to you. I hope you had a couple of good weeks off. We had a little bit of a reprieve there, so we got a bunch of people that were invited to join us today, so that's great to have everybody jumping on. And let me just say hello to Antonio, who's here. I don't recognize Antonio. Maybe first time for him. Perfect. All right. So, John, what a crazy year, 2021. I mean, the conversations that we have had over the last, maybe 9 months or so, they have been all over the place when it comes to credit, what people are doing with credit, and then the pandemic seems to have thrown a wrench into everything. I mean, we are certainly living in very interesting times, especially when it comes to credit. One of the things that I was surprised about, I don't know if you were too, one of the things that I thought was going to happen with all the shutdowns and everything is that we were going to see credit card debt go up. It turned out that wasn't the case. Credit card debt went down. Scores weren't impacted too heavily because of all the federal help that took place. So now, wrapping up 2021, we're full steam ahead in 22. Thought we would talk about what do we think is going to happen in 2022. I mean, it seems like there was a big reprieve with all that the help that people were getting, not having to pay the mortgage. A lot of creditors were stepping in and not doing what would have normally taken place under these conditions.
Yeah, the word you're searching for is accommodation. And a lot of lenders were either forced into giving accommodations or they chose to give accommodations. Yeah, I think, look, if we would have had this conversation in March of 2020 and you asked me, hey, what do you think is going to happen? I fully admit that I would have guessed that credit card debt would skyrocket, defaults would skyrocket, and credit scores would plummet. Of course, this was before the CARES Act, and no one really knew how the CARES Act was going to affect all of those things. What we ended up with was essentially temporary statutory protection of our credit reports from lenders and servicers. And the result of that was, believe it or not, actually the highest average credit scores ever in the history of credit scores. So late last year, the average FICO score hit 716, which is an all-time high. Yeah. And the only way you end up there is you end up with without mass defaults and without a massive increase in credit card debt. Actually, the Federal Reserve published several studies over the past 24 months that clearly indicates that credit card debt is either staying consistent or actually going down in some respects. And why that has occurred, who knows, right? I mean, unemployment is not great right now. The stimulus checks were not massive amounts of money over long periods of time. And so it's kind of hard to blame or give credit to any of those things for our debts staying consistent. What we one of the, I think probably a better explanation is you weren't required to pay your federally guaranteed student loans. You're still not required to make payments on your federally guaranteed student loans. So that's money that wasn't going to the loan servicer that now could be redirected elsewhere, like towards your credit cards. If you were given accommodations on your mortgage loan, that's probably your largest monthly expense. And if you're not making the largest monthly expense because your loan is in forbearance and you're still employed, then obviously you can redirect those monies elsewhere. And so I think those are probably more realistic explanations as to why we didn't see massive defaults. That plus the accommodation provision in the CARES Act, and then also why we saw kind of an increase in the average score to where it is now, 716.
Yeah. And I want to expand on that. We got a question from Antonio. I love this question because lately, I don't know if I should say I love it, but it's been like a source of friction for my Facebook comments. And I'll explain that in a second. But Antonio's asking, how can the system work well? I'm going to make the assumption, Antonio, that you're talking about the process of disputing. How can the system work well without correcting my personal information with the 3 credit bureaus? John, you and I have talked about this so many times, but we always have new people on. It's the first time they've asked this question, probably the first time they've gotten a real answer from a real expert. And again, John, I think that the way you phrased this was one of my favorites. And this is a video that you did for us some time ago, which is this falls under the category of credit bureaus aren't dumb when we're talking about trying to delete name variations and addresses.
Yeah. So, the word correcting is sometimes used as a euphemism for getting stuff removed, right? So and for those of you who are new on these Facebook Lives, I use Webster's definition of correcting, which is the actual definition of correcting, which means to remedy something that is incorrect. And so certainly if you have information on your credit reports, including PII, which is the personally identifiable information, so your names, your address, your social, all of the things that could be directly linked to you, and then other things in the identification section of your credit report, which would include the AKAs, you're also known as, you're formally known as, the different spelling variations of your name, and then also your prior addresses. The credit bureaus do a pretty good job of maintaining multiple prior addresses. I still have a prior address from like over 20 years ago on my credit report from when I lived in Florida for a brief period of time. So obviously you have the right to challenge that information and have it either corrected or removed if it is incorrect. I think the assumption is that if you're able to start removing the personal information from your credit reports, that all of a sudden all this negative information that is probably accurate is somehow not going to be able to be associated with with you personally when they compile your credit report. I can tell you that in 30 years, I've never seen any evidence that suggests that that's true, right? Which means it's a theory, right? I mean, a theory is a theory, and an evidence-based finding is evidence-based finding. But it certainly is something that there's no shortage of YouTube videos giving strategies on how to repair your credit reports or get negative information removed. And one of the ways is to try to remove as much kind of superfluous information from your credit reports as possible, with the theory that somehow the credit bureaus can't associate information to you if that information has been removed. I've even seen lately, some people who are in credit repair are really, really aggressive, meaning that they love to kind of red line and push the car to the as high of the RPM as it can go, with the whole credit sweep and all that garbage. And one of the theories that I'm seeing more recently is that you should try to get the credit bureaus to remove even valid identifying information, like remove your middle name or only maintain a portion of your date of birth or only maintain a portion of your social security number rather than maintaining your full and complete name that's being sent to them every month by your creditors, and then also your full date of birth and your full social, which obviously is a requirement when you go out and you apply for some form of credit. So again, look, this is the beauty of disputing things is the whatever letter you write or whatever you type on their website when you're submitting a dispute, you can say or challenge it however you want to challenge it. I just want to kind of draw a line between anecdotal versus factual based evidence and findings. The Fair Credit Reporting Act is factually there and exists so that people can challenge information. There's nothing in the Fair Credit Reporting Act, and I can assure you of this, there's nothing in the Fair Credit Reporting Act that suggests the credit bureaus have to remove valid identifying information or identification information from your credit reports or anything else on your credit reports that they find to be accurate.
Well, John, and you made this illustration a long time ago when we probably one of the dozens of times we've talked about this subject, that you said, well, let's just suppose for a second that worked. Let's say that somehow you could game the system and you remove some old names and addresses. Well, wouldn't that also put your good credit at risk as well? I mean, if you moved and you changed your address and maybe you had a name change or something like that, or this applies probably more commonly with women, they have a maiden, get rid of a maiden name. Well, wouldn't you wouldn't want that to work because maybe you lose some of your good credit too. I mean, if you can disassociate yourself from your credit just by something so simple as changing a name or an address.
Yeah, I mean, it kind of illustrates, I mean, it almost disjoints. It's a further degree of separation between, it really is just scorched earth. I just want to get stuff removed, then I'm willing to try everything. And whatever collateral damage occurs, then I'll deal with that when it occurs, and I'll deal with it however I want to deal with it. I think one of the things that people need to be cautious about, number one, is accidentally getting good stuff removed, right? Because then you can't call them and say, whoa, I want to take that back. You can't do that, right?
Once
you've rung the bell, you can't unring the bell, right?
Yeah.
So that's number one. Number two is you may actually cause something to be removed that is net more helpful to your credit score than it is harmful to your credit score. And then a really good example that we talk about all the time is, a charged off account that's 6.5 years old, but was opened 15 years ago, right? And then boom, you argue about it, you get it off your credit report, and now you have this 15-year-old trade line that was really not that much of a problem anymore anyways because of its age. And now you're not getting any benefit out of the age of the account. So, and that's also one of those, oh, wait a minute, what did I do? What did I just do here? You can't call them back and say, hey, look, my bad. I want to withdraw my dispute. Once it's gone, it's gone. Mm-hmm. So but again, I get it, right? I mean, people don't think about how cold the water is until they've jumped into the water and it's too late. They're in the water. So I just caution people to be cognizant of that. You may break a whole lot more eggs by simply doing what you're doing, and you may not want to have broken those eggs, and you can't fix them.
Yeah, Antonio, I hope you're still listening. I know that was a long explanation, but it's really important to understand this because John, with a background in the industry, like John is probably one of the only guys you're ever going to hear speak about this that actually comes from inside of the industry itself. Everybody else is a credit repair guy or maybe has some kind of outside experience with credit. Maybe they were in banking or mortgage or whatever. I know some expert witnesses come from that area as well. A couple of people that friends we have in common, or people we know in common, John. But it's really good to get this information from somebody who knows it firsthand. And the value of this too is myself in the credit repair space, really credit repair / software space. There was a time where I believed this myself. I really did. Because when I came into credit repair, John, the first time I met you going back to 2012, just really in passing at a boot camp, I think. These are some of the things that I believed early on. Okay, we got to delete all the names and addresses. This is the pattern that we got to go through in order to make things happen. And then you get in this business a little bit longer, and you're fortunate enough to run into people like John and people who come from the industry itself. Then you're like, you get real information. So So, Antonio, whatever you're doing, if you're doing credit repair, you're just trying to learn about credit, it's really important to question some of this stuff because I'll tell you, as a guy that's been in this industry for a decade, I'm talking about the credit repair space, there's a lot of nonsense. A lot of nonsense. So, John, we're going to go on to the next question here. Aaron's got a great question. But just to give you a perfect example, I typically don't like argue with people on our Facebook posts, especially when they're wrong. And I had this come up over the weekend. Somebody said, "Hey, how come you're telling people it doesn't really matter, that there's no big benefit to removing your names and address?" And I said, "Listen, I can appreciate you got some zeal for this. I was once in your place too, so I'm completely aligning with them." And I said, "Listen, let's do this. I'm going to show you a video from a guy that worked at FICO and Equifax, is the most quoted access credit expert in the country. He did a video on this subject. Let me give it to you. Watch it." And all I got was vitriol. Just no. Nobody knows what they're talking about. So I'm like, okay, that's the credit repair. That's the sickness of this industry, which is one of the reasons why you and I get on live every week to talk about this stuff. Okay, so Aaron is back. Happy New Year to you, Aaron. Good to see you again. Jason, welcome. Jake, good to have you here. And then Aaron's got a question. Can you please talk about online credit card applications? What determines an instant approval versus denial, or a pending, and how your initial credit line and APR are determined?
That's a good one.
That's a really good one. When does Aaron not ask a good question?
When he doesn't come and attend one of our Facebook Lives.
Exactly.
His questions then are just terrible. So, all right.
No thought was put into it.
So this is actually an underwriting question, which I really like. So when there are probably between 8,000 and 9,000 companies in this country where you can apply for a credit card. The overwhelming majority of them are credit unions, and many of them are banks, and many of them are the credit, like the big box credit card issuers. And every single one of them gets to determine what they want to see from an applicant's information, which is going to include their credit report, some credit score or credit scores, and then also the information that they have input into the application. So that's another thing that we rarely talk about that's also really important, is the information that you put into the application is also scored. They're scored by what are called application scoring systems. So things like your income, how long you've been in the same industry, how long you've been employed, all that stuff is scored. So that's why a lot of that stuff is a quote unquote required field. You'll notice that a lot of these places, they make you answer these questions. In many scenarios, it's because that information goes into a scoring algorithm. And so they gen out a score based on that information. So depending on how well you do with that process, the credit report, the credit scores, and then the application information and application scores, you're going to fall onto a matrix, like a 2 or 3 dimensional matrix. And that matrix has been created by a person you're never going to meet in a state that you're never going to visit, prior to you ever hitting submit on your application. And that was essentially their underwriting guidelines with respect to whatever product it was that you're looking at online. So whether it's a credit card or some sort of a rewards card or a balance transfer card, or some charge card if you're on the Amex website. So regardless of where you're clicking and entering your information, all of that decision making structure is basically running in the background and just waiting for you to submit your information. You're giving the lender permissible purpose to access your credit report and scores. All that information is fed through an automated application underwriting system, and it spits out a response. And that response is going to be one of a variety of things: that you're approved, you're denied, or that you fall somewhere in between. Either your application is pending and it requires manual review. Maybe your credit reports are frozen and they weren't able to get your credit reports, and now they're contacting you to let you know that you need to thaw your credit reports so that they can actually get to your credit reports. Maybe they want supplemental information about your income for example, if you're applying for something that is a really large dollar amount type of extension of credit and they need more information to validate income. So that's going to be where they kind of put your application into some sort of pending mode or suspense mode until they can get more information from you, including probably access to a credit report. Or you may get back a counter offer. So if you apply for a certain credit card and you are denied for that particular card, they may come back with an alternative. So a counter offer, which could either be one of their, not as good credit cards, or they may actually refer you to a partner of theirs, a lending partner of theirs that does have products that are tailored to people who have your level of risk. And so all of those responses are going to fall into a variety of categories. One where you're going to be approved, you're going to get the card in the mail, you're going to have to activate it and you can start using it. A denial, which you're soon going to receive in the mail, something called a notice of adverse action, which is the form letter that most people refer to as a denial letter. And it's a couple, 3 pages long, and it has a bunch of information about your rights, your credit score, where they got the information, how the credit bureaus didn't make the decision, that they weren't a party to that process. And it's going to give you some information. It's going to tell you what your credit score is, and it's going to give you some guidance as far as what your rights are. Or that kind of between the two extremes response, which is going to be probably maybe a phone call or some sort of communication from the creditor asking for some sort of supplemental information or indicating that your credit reports are frozen and you need to go and thaw them so that they can continue processing your application. But I think the interesting thing that people don't realize is, number one, is the importance of the information in your application and how valuable that is to the lender's consideration. And number two, that this is an automated process, which is why you can sit at your computer at 2 a.m. and by 2:15 a.m. end up with either a credit card coming in the mail or a denial letter coming in the mail, because you don't need a human being sitting there staring at your credit report, because the engines that run these decision engines are pre-existing and are basically just running in the background waiting for people to apply for things.
Yeah, it's really seamless. I haven't gotten a new credit card in a while. It's been a couple of years since I got my last one, except for recently, where my girlfriend says we got to get a Costco card. So I ended up getting a Costco card, and then it was just one of the nice things about it too is she works there, so she was behind the counter filling everything out, and it's like that. There's no waiting, there's no questions, and it spits out your approval, or in some cases a denial.
You know what that's called? It's called instant credit. So that's instant credit. Instant credit has evolved from you standing at the cash register or going into a hardware store and walking out with a lawnmower because you were able to get instant credit, to being able to go into a retailer and have a bunch of clothing and then apply for a card at the register and save 20%, to your example of going to Costco and getting something almost in real time. That's what we kind of informally refer to as instant credit. Aryan kind of had another end of his question that I didn't address that I don't want him to think I'm ignoring that part. And the question is how your credit limit and your APR is determined. So that's also part of the process. And so your credit limit, whatever product it is that you're applying for, whatever type of card it is that you're applying for, so if you're applying for something like a really high level platinum type of card, it's going to have a much higher cap as to the credit limit that they would be willing to give you, versus something like a classic credit card is what I think it's referred to these days, which is kind of pejorative because it's like the lowest level, entry level credit card, where you may end up with $300 credit limit or a $1,200 credit limit, something certainly pretty low. That's all based off of risk as well. And so that's another kind of use of the credit report and credit score information, is that they will determine your APR based on whether or not they feel that they need to use the APR and the credit limit as a way to mitigate the risk of doing business with you. So someone who's got, fantastic credit and has, a good income, they're going to qualify for a higher credit limit and a lower APR because there's no need to use those tools to mitigate your risk. Everything about you that they have been able to pull from the credit bureaus and information from your application, which is verifiable, says good things about you. kind of to the flip side, someone who has a poor credit score but still good enough to get approved, and has a lower capacity, meaning a lower income, they mitigate the risk of doing business with that consumer by charging them a higher interest rate or a higher APR and a lower cap on their spending limit. And people will look at that and think, wow, you're really treating me unfair. And that, no, you're not treating you unfair. They could have denied you. If you don't allow banks to risk space their pricing, then the easy response from them is, well, then we can't do business with you because we're not going to give you the same deal that we give to someone who's got FICO and Vantage score 800. You haven't earned it. Come back to us when you do have those types of stratospheric elite scores, and we're happy to throw large amounts of money at you at really competitive terms.
This also kind of bleeds into a subject that lately has become very popular, about the fairness of credit reports and credit bureaus. And from what you're explaining and everything that I've learned about credit over the last decade, this is an extremely fair process. I mean, to the extent that you have complete control over what goes on your credit report, the outcome of paying your bills or not paying your bills. And I'm not trying to diminish the fact that events happen in people's lives that change that. But it's still, even when those events take place, it does represent a certain measurable risk in that individual. And that's exactly what we're talking about. Is you're not going to get the same great deal at a 600 score as somebody who's got an 800, who's got a credit file that's 10, 15, 20 years old. So I think it's a very fair and very rational approach at extending credit to people who apply. I don't think there's anything punitive or unfair about the process at all.
That's right. And look, I can guarantee you there's nobody in the comment section who's got credit scores above 800 that is complaining about the benefits they get because they've got credit scores above 800, right? Yeah. Typically the only people that complain about the deals you get when you have those really great scores are people from the National Consumer Law Center, which basically hate everything about the credit system. Perhaps some people from the CFPB, which are very, very critical about all things having to do with credit, or people who have bad credit, who are the ones who are getting these high APRs and these low credit limits. The alternative, there's a couple of alternatives, and I have one of my New Year's resolutions is to try to be, not argue so much, but at some point I don't know, you got to treat an adult like an adult. And, if you have, it's like insurance. No one complains about their insurance premium. If you've gotten a bunch of tickets and you have a DUI in your past, no one complains about they may complain about their premiums, but they understand why their premiums are high. Yeah, I've got a heavy foot. Yeah, I drive a fast car, sports car, and I drive it fast, and yes, I got busted for a DUI a few years ago. There's a reason why your premiums are what they are, and it's kind of the same thing with respect to credit. Is that you earn what you get. The deals you get from creditors are what you earn, just like the premiums you pay for insurance policies. You earn them, and there are tons of insurance companies, just like there are tons of lenders. And if you're ever not happy with the APR and the terms with any of your creditors, it's a voluntary system. Your business is portable. You can refinance a loan with another creditor. You can open a new credit card with a new credit card issuer and close the old card, kind of as a way to vent your frustration with your creditor. But I tend to shut off my ears when I hear people who have really horrible credit scores complain that they pay too much for their credit and refuse to acknowledge that they weren't born with FICO 400, right? I mean, you get what you earn. And unfortunately, some folks who have low credit scores, and the backstory, look, I'm not insensitive to the backstory. So David, you brought up the backstory. I'm not insensitive to the backstory. If you look at any research that's done about bankruptcy, for people who don't understand credit, or maybe not they don't live in the credit environment. The minute they hear bankruptcy, they kind of associate bankruptcy with deadbeat. Oh, you're a deadbeat. You didn't pay your bills. You gave up. You waved the white flag. You had to file bankruptcy because you can't deal with credit. That's not really true. If you look at any research as to kind of the distribution of people who filed bankruptcy and the explanations, there's it's a very low percentage of people who did it because they're irresponsible. A lot of people file bankruptcy because of other situations that they didn't choose. No one chooses to get sick and spend a ton of their money paying medical bills, right? No one says, you know what, I'm going to get COVID this week and I'm going to ruin my finances. I'm looking. No one does that, right? And no one, I don't think, anyways, I don't think people choose to get into horrible marriages and go through expensive and horrible divorces, which are very, very expensive, and which eliminates at least 50% of the earning, or up to 50% of the earning power in a household, and therefore you may not be able to pay your obligations. And there are a ton, failed businesses. We want people to try to open businesses. They're the engine that runs the country. So but a failed business partnership or a failed business can lead to personal bankruptcy. So there's a lot of there's a lot of backstories that are sympathetic, and I get it. The problem is that the banks don't care. Banks don't care why your credit score is a 500. They only care that it is a 500. And the 500 tells a story, and the story is lend to this person with a lot of caution. Regardless of what their backstory is, lend to this person with a lot of caution. And so to the extent that you're unhappy with how the credit system, I understand that, but I also think you have to be realistic with your expectations, and a lot of the times you do in fact earn the scores that you have, and you have to live with them accordingly, which is why we sit here and preach ad nauseum. Here's how you can improve your scores. Here are some valid methods that you can use to improve your scores, and deleting your third former address and all of your names. That's never ever part of the above board white hat advice that people are given to improve their credit, because it's not. It's nefarious. It's underhanded. It's not valid. No reliable or authoritative source recognizes those methods as good ways to build credit and improve credit. You'll never hear FICO tell you to do that stuff. You'll never hear the credit bureaus to tell you to do that stuff. You never hear the FTC tell you to do that. You never hear the CFPB or anyone from the National Consumer Law Center, all of whom are clearly on the side of consumers, except for the credit bureaus in that scenario. No one tells you to do that, but some dude on YouTube standing in front of a Ferrari that he doesn't own, in front of a house that he doesn't live in, is really, really pissed off at you if you tell people that that's not really a good way of improving your credit, and he's going to argue with you on Facebook.
Exactly, yeah. And I try not to get into those arguments, but to a certain degree, they're inevitable, especially when you're trying to undo a lot of the damage that's done by bad information.
I mean, ask yourself, all right, is what I'm hearing, I mean, is that really good advice? People aren't stupid. I mean, is that really good advice? I've been asked a million times, John, how can I improve my credit? And I give the same answer. It's like losing weight. Stop eating so much and run more. It's the same thing. Yeah. Don't miss payments. Don't get in so much credit card debt, and don't excessively apply for credit. If you lather, rinse, repeat, all that stuff, you'll never watch one of our Facebook Lives again, because you're going to have scores so high that you're going to be, fighting off lenders who are throwing money at you at really low rates.
Yeah, and if you find yourself in a situation where that's where your credit score is, that's what your credit report is, because there's a backstory somewhere. And that's also the reason why we do these Facebook Lives every week, because everything is temporary. I mean, the very fortunate part about this is there's only so long the derogatory information stays on your credit report. You get a second chance. The older it gets, the less impact it has. And making good decisions, swinging back around and going, okay, well, that was however you got in the situation that you got in. You can look at it for what it was, understand that this was a route that led to some bad credit, and look at the bright side that it might not take you but 6 months, 18 months, depending on what the credit file looks like, to get back on the positive side of good credit. In fact, this kind of swings into Jason's questions. I know that John and I went off on a little bit of a tangent there, but there's some of this stuff that's just such bad advice that we have to address it and we have to kill it in as much detail as we can. Otherwise, it just seems to resurrect itself, which I think to some degree it's going to do that anyway. All right, Jason, what is the most effective way to increase your credit score and credit line? I'm new to the credit world. Excellent. Let's give some sound advice for this person here that's new to credit to save them from some potential mistakes.
Yeah, so I'm gonna answer your question in reverse order. I'm gonna tell you what the best way is for you to increase your credit line. I'm gonna assume that when you say credit line, you mean a credit limit issued on a credit card. So the credit line on your credit card. So keeping in mind that other than credit unions, all banks and credit card issuers are for profit, which means that they're in business, just like all small business owners are, to make a living and make a profit. And in order for a credit card user to make money, there's a variety of ways that your usage of your credit card helps them to do that. Number one is you have to use your card, because every time you use your card, the merchant that accepts the card pays the merchant fee, or some people call it the swipe fee. It's called interchange is what it's really called. But it's basically the fee that they pay for the ability to accept that particular card. And you'll see some retailers want to add 2% or 4% to the transaction to help them cover the cost of the swipe fee. So number one is use your card, because the more you use your card, the more money that everyone else makes, right? The issuing bank and the network makes. And to the extent that you do that, and you do that a lot, they're going to be more willing to increase your credit limit because they see that they have an active card user on the hook. That's number one. Number two is you've got to make your payments on time. They don't make any money if you go into default. Actually, they lose money if you go into default. Actually, if you looked at someone who opened up a credit card and charged $20,000 on the card and then never made any payments, the credit card issuer is going to really lose a ton of money. They lose the 20 grand that's been charged and paid out to merchants. They lose the cost of opening your account, which includes buying the credit report, what's called onboarding. They've onboarded you. There's a cost associated with all that stuff. And if you look at that amount of money that they're going to lose on a bad risk, a bad bet, they lost this bet, versus the money that they're going to make on you, Jason, because it sounds like, you're new to credit. Hopefully you used credit properly. It's going to take them decades, perhaps never, to make the amount of money they would lose on someone in 1 month who maxed out their card and went into default. So it's hard to be a credit card issuer, right? They can't come repossess anything from you because, what are they going to come do? Repossess dinner? Repossess your shoes? They can't come do that. So that's why you see credit card issuers be so sophisticated with their assignments and APR. So to the extent that you pay your bills on time and that you actually use the card, that is an incentive for the credit card issuer to increase your limit, which is an increase in your buying power. So that's number one. Number two, the most effective way to increase your score, look, this is as complicated as people would like to make it. It really isn't complicated. When you say you're new to credit, I have to assume that means you're relatively young and you just haven't had an opportunity in your life to have a lot of credit yet. Your credit score is moving, meaning that just as your score is 700 today doesn't mean it's going to be 700 tomorrow, and it doesn't mean that it's going to be higher or lower. It all depends on how the information on your credit report, is reflected and changes over time. So the the number one way to maintain a high score is to avoid any derogatory information from hitting your credit reports. And the number one way to do that is to never ever miss payments and never ever go into default. Then you don't have to worry about things like debt collectors. You don't have to worry things like considering bankruptcy, and bankruptcy attorney is the best choice for me, because that stuff will never ever be in your future. Number two is you've got to maintain control of your debt, which means low balances on credit cards if possible, fewer accounts with balances rather than more accounts with balances. Installment debt is fine. Avoid buying a house, buy a car, but just it's the credit card debt that really can be problematic. So see if you can maintain respectable amounts of credit card debt if possible. And then those are the big ones, right? That's like 2/3 of the points in FICO and 2/3 of the points in Vantage Score. Everything else is kind of superfluous. Things like, don't excessively apply for credit. As your credit report ages, you're going to earn more points organically just because the information is getting older. And if you do that and do it repeatedly for year after year after year, then your credit scores are going to be fantastic. And you're never ever going to have to worry about how to build my score, how to rebuild my score, and you're going to have your pick of the litter as it pertains to the quality of the lenders that are out there, and you're going to have really, really killer deals. Like at least a couple of months ago, you could have gotten a mortgage loan for less than 3%. And I'm not sure if the auto industry is still like this, but there was a time where you could get 0% on certain makes and models of cars. So, but those are deals that are reserved for people who've got really solid credit and really solid information on their applications. And so, it's more than just, hey, I want a high number. It's wealth building, right? If I'm paying $1,000 a month for a loan, but I could be paying $700 a month for the same loan because my credit's not as good, that's $300 a month, $3,600 a year, times however many years that takes you to pay off your loan. That's going to a lender. That's not going in your pocket. That's real money, right? Yeah. You spend a whole lot of time picking the right mutual fund. You pick a whole lot of time trying to pick the right stock. You spend a whole lot of money trying to buy the right crypto. And really, it's a whole lot easier. All you need to do is have great credit scores, and you're going to pay less for things that you're going to finance throughout your credit life cycle. And it's guaranteed wealth building versus other things which are more speculative.
Yeah, exactly. All right. So to the previous questions, Arian says, thank you for the answer. Jason said yes, correct. So he was responding to your suspicion that he was young and new to credit. Scott Oliver, I know that name. He's got a question as well. Scott, just got a new job. How will that affect getting approved for a car loan? Been in the same industry for 21 years. Good question, Scott. Good to see you.
Hey, so number one, congratulations on the new job. That's awesome. I very rarely share posts on Facebook and very rarely share posts on LinkedIn. But whenever I have quote unquote friends that post that they're hiring for certain, I almost immediately share those, because I understand the financial value and also the other emotional benefits of having gainful employment. So congratulations. I'm thrilled for you that you have a job, and I hope you make a gajillion dollars. It really depends on what it is that you're applying for. Certainly being in the same industry for decades is extraordinarily helpful. But really it boils down to the quality of credit and your income relative to the amount that you're trying to borrow. That would be, and also the value of whatever it is that you're trying. So in other words, if you're going to buy a car and the car is worth $30,000 and you put $10,000 down, then you've basically paid down 33% of the principal amount of whatever. So in other words, you're going to get a much better deal on a loan because the lender knows, wait a minute, they've put 30% of skin in the game. So really, I'm only lending on 60% of the value. It really depends on how much you're going to put down. So that's called the loan to value ratio. And then number two is your income. You might want a little while before you get a few paychecks under your belt. because you may have to produce those if someone asks for verification of income. But they're going to see what your gross monthly income is relative to your minimum payment requirements every single month. And they're going to, that's called the debt to income ratio. And if you calculate it by dividing the aggregate of your gross monthly income divided by the aggregate of your monthly payment obligations. And that's usually something that you're going to want to keep below 40% if you want to buy a house, because that determines the capacity that you have to take on a new obligation. So the lower that ratio, the better. And so depending on how much income it is with this new job, then whatever it is that you're applying for, you're going to want to keep in mind that if you're applying for something that's going to have a monthly payment that's going to spike your debt to income ratio, then you're more likely to get denied because of nothing to do with your credit, but having everything to do with income. And so, these are just things that you're going to want to keep in mind. And look, you're a loan officer, if it's a mortgage, or the finance and insurance manager, or the F&I person at a car dealership, this is not news to them. They know all these things. And so they don't make any money by you alone. These are all commission-based professions, and they want to approve you. And so one of the ways that they're going to try to approve you is to shop around your application to different indirect lending sources to see if they can get you an approval, and then also a deal that you can afford to make payments every single month. And so they do better when you drive off the lot in one of their cars than drive off the lot in your car with a denial letter.
Yeah, and one of the good things too right now, Scott, is it remains the same as it was a year ago when I bought my car, but auto money is really loose right now. So the qualifications are a lot lower than what they used to be. Interest rates are a lot more attractive than what they used to be. Seems like every time we go through any kind of economic shift, first thing is, hey, let's just start selling things at a discount, drop the interest rate. So, I mean, to the extent that that's a good thing.
And generally speaking,
oh, go ahead, John.
Generally speaking, anything, if you have scores 720 and higher, assuming everything else is good, like the income stuff, then the best average interest rates for car purchases or for financing an automobile are for people who have 720s and higher. And so that's only 4 points above the national average. So you really don't have to have the elite level credit scores to get the best average D loan. And it's kind of been around 720 for a while. So the bar isn't as high as you may think it is as far as getting a killer deal for an auto loan. I mean, and the way that the credit scoring systems are set up is there's a lot of tolerance built in them to allow you to go around and shop for credit with different lenders in a pretty compressed period of time, and let them fight over your business and let them see which kind of deal they can give you that's the most attractive, and then rock and roll with the best one.
Excellent. Great question, Scott. And we've got, so Coy, I see your question posted down there in all caps. I see it's from Facebook. It's more of a credit repair question, so I'll answer that offline. We usually do more credit education when John is with us. And credit repair is something I'll take care of myself after the video, but I promise I'll get to it today. Okay, so it looks like, what are we coming up on, John? 50 minutes. Okay, that is our allotted time for the day. Fantastic live for kicking off the first live for 2022. A lot of great questions today. And John, you and I will be on again in a couple of weeks. So everybody that watched today, thank you so much for joining us. And if you do watch this video on a replay, feel free to ask questions. This thread is constantly checked, and I promise I'll get to them as quick as I possibly can. John, thank you so much. Look forward to meeting up again in a couple of weeks.
All right. Thanks for having me. Thanks for watching, everybody. Y'all have a great rest of your evening.
Take care, guys. Thank you.